This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this interview is Masa Takeda, portfolio manager of the Hennessy Japan Fund. We're going to discuss the current environment in Japan. Some individual stock ideas are going to be discussed as well. Masa, thank you so much for joining Viewpoints by Hennessy.
Thank you very much for having me.
All right, so let's get started. Recently, on a Bloomberg Daybreak Asia interview, you spoke about the Bank of Japan and their neutral guidance going forward. How should investors think about this as it relates to investment holdings in Japan?
Well, so Bank of Japan, for the time being, they are determined to maintain the status quo in terms of monetary policy. And that's good for the economy. When you have expansive monetary policy, interest rates are lower. And in the case of Japan, that generally means weak currency. And Japan being export-oriented economy, it helps international competitiveness, the export companies. And that should eventually translate into more domestic-oriented industries. So overall, we think that Japanese economy is in good shape.
Okay, so you already alluded to it, but could you go a little deeper and share your thoughts on how this will impact the yen, not just now, but for the rest of the year?
Yes, so for now, interest rates in Japan remain unchanged. And so the long yields will be primarily driven by U.S. interest rate environment. And so if the Fed continues to raise interest rates, then that would mean widening of interest rate differential. And that also means depreciation of the yen. So that's what we should expect to see going forward.
Okay. If the Fed were to suddenly pivot and reverse course sharply, like they've done a few times in the past, what type of impact would that have on Japanese equities?
So if the Fed changes its direction, then it may create some repercussions on the Japanese stock market. So what we want to have in terms of currency environment is and also the inflationary environment. As long as the yen depreciation, the pace of depreciation remains moderate, then that's good for the economy, for the Japanese economy, that is. If the yen depreciates too fast, then Japanese households will suffer through higher import prices. So the inflation will accelerate, and that's bad for the economy. So right now, we are in the sort of sweet spot where we have expansive monetary policy and also a very favorable benign currency environment.
Masa, you were recently on CNBC, and in that interview, you discussed why you feel valuations in Japan today are very compelling. Why specifically do you find them attractive today?
Well, so Japan, if you look at metrics like P multiples or price to book ratios, Japan trades at a much lower levels than the U.S. And that's primarily due to perennially low return on equity in Japan. But that has changed. We've come through a lot of changes in the last 7-8 years. Corporate governance code, stewardship code. Those were some of the initiatives under the so-called Abenomics, led by the late Prime Minister Shinzo Abe. And so there's much more awareness around returns on capital, returns on equity. You hear companies explaining their financial performances in those terms, and that's a big difference compared to let's say 10, 15 years ago, when the return on equity for Japan was only at 5% or mid-single digits. Today, it's come up to close to 10%, and we're not done yet. I think Japanese return on equity will continue to improve, such that there will be scope for the market to re-rate. And of course, the earnings momentum is also very important. And as I said, under the current environment, I think the companies are enjoying a nice tailwind. However, I must add that for U.S. dollar-based investors, the weaker yen means reduced dollar-based returns on Japanese equities. But I would argue that if you're invested in high-quality companies, especially global companies, the current weak currency is actually a net positive for the international competitiveness of these businesses, and therefore U.S. dollar-based investors are compensated by this.
Well, so let's talk about a couple of companies. In that same CNBC interview, you mentioned Seven & I. What is the investment case for Seven & I today?
So Seven & I is the largest retail group in Japan, and they run convenience store businesses in Japan and the US, and they are number one in both markets. In Japan, there are only 3 players, including Seven & I, and Seven & I has the largest market share. It's largely saturated. Over in the US, again, Seven & I has the largest market share with about 9%. And US is a growth industry. The convenience store industry is much bigger than Japan, and is also very much fragmented. So there is a significant runway for growth for Seven & I as they continue to acquire smaller competitors. In addition to that, Seven & I, or 7-Eleven, is the largest retail store network in the world. So there's about 80,000 plus stores around the world, including Asia and other regions. Seven & I has yet to monetize from this enormous store network. And coincidentally, U.S. activist fund ValueAct has taken a significant stake in the company and currently running a shareholder campaign demanding replacement of key board members. We do admire the current management team for running a very successful 7-Eleven franchise in Japan, and we don't disclose which side we are voting for, but we do think there's still a lot of room for the company to improve, and so there are a lot of things that they can do a lot better.
Let's talk about Mitsubishi. Several years ago, Warren Buffett took a position in it. You took a position in it 16 years ago. What is your investment case for Mitsubishi?
So Mitsubishi Corporation, it's been around for over, if I'm not mistaken, over 100 years. So their history goes back to pre-World War era. It's trading. It started out as a trading company, and so it was assisting Japanese companies with importing and exporting of finished goods, raw materials, and natural resources. And they were earning commissions. Fast forward to today, they have become an investment company. And so their balance sheet today represents a unique collection of operating businesses, operating assets, as well as investment securities. And their per share net asset value has compounded at high single digits to 10% over the last 5, 10, or even 15 years. Despite that, the company is trading at a value stock-like multiple, single-digit PE, and price to book around 1 time, or even less than 1 time. Dividend yield of 4 to 5%. We think it's attractive investment.
Let's pivot and talk about your fund. You're the portfolio manager of the Hennessy Japan Fund, and you've been running that fund for 17 years. Let's start at a high level. What is your investment process for this fund?
So we are benchmark agnostic and macro agnostic investors. Our investment philosophy, in just one sentence, is investing great business with exceptional management at an attractive price. So we do study and interview companies each year, by the hundreds. And we construct portfolio, picking stocks one by one. And we are long-term, and we run concentrated portfolio.
On average, how many holdings do you have in the fund?
Generally between 25 and 30 names.
Okay. And then what would trigger a removal of a security from the fund? What are your risk controls?
Yes, so we look at the competitive strength or the moats of the companies we own. And we intend to be long-term shareholders. Now, when we remove a stock from a portfolio, usually the stock falls under either one of the three following situations. One is if the stock is trading at excessive valuation, then we decide to trim the position or even close out the position entirely. Number two, if the business is deemed to be suffering from erosion of the moats, then of course we have to change our investment view and exit the position. And then lastly, if there's a better alternative on the market relative to what we own in our portfolio, then we will replace our existing positions.
So, Masa, what's a name in the portfolio today that you like that we haven't already discussed?
In addition to the ones I explained earlier, I also want to highlight Hitachi, which is a large industrial group in Japan. Again, a long history. And the company makes everything from electrical equipment, heavy industrial machinery, medical diagnostic equipment, home appliances. They also build IT infrastructure for financial institutions, and they also build and operate railway systems, power grids, and power plants. So they do a lot of things, and they have all these expertise under the same roof, which makes them very unique. Hitachi back in up until 2008, Hitachi was regarded as a poorly run company, and they incurred heavy losses at the height of financial crisis. But after that, they went through a lot of restructuring, and then since around 2016, they started to transition their business model from hardware sales model to more of a solution-based model, leveraging the expertise I mentioned earlier. And as the software portion of the business grows, we expect the company's margins to improve, and also returns on capital to get better. And also, there should be more cash flow generation going forward. Nevertheless, the company is trading at low teens, and we think the company has big upside from here.
So, Masa, let's wrap up with this question. We're recording this in about the middle of the year 2023. What's your outlook for the rest of the year for Japan?
So, as I said earlier, we have the central bank that's business friendly and pro-inflation, so that's good. In addition to that, we're seeing strong recovery in inbound tourist numbers. So back in 2019, the peak number was 30 million tourists visiting Japan, and they contributed the contribution accounted for about 1% of GDP, so which is meaningful. Now we are seeing recovery of inbound tourist numbers, and that's another strong tailwind that Japan is seeing right now. And then lastly, large base salary increases won by labor unions across Japan during the latest spring raise negotiation season. That's also very positive for Japan, because Japan has been under deflationary environment for so many years. So inflation is something we desperately need to create a virtuous cycle in the economy. And so the monetary policy, recovering inventories, and also real wage growth turning positive. I think these three factors are very, I think, very encouraging for the economy. So we are pretty excited about for the remainder of the year and also onward.
Masa, thank you for coming on Viewpoints by Hennessy. To learn more about the Hennessy Japan Fund or any of the funds in the Hennessy Fund stable, please visit hennessyfunds.com.